All right. Well, thank you all for joining our virtual fireside on crypto and corporate treasury management. There's really a lot of interest from the institutional market participants in this space to understand how crypto can be utilized as a corporate treasury tool. And today we're going to explore some of those topics. So it's important to note that corporate treasury, that as a function, is not a one size fits all, right? The topics we discussed today may not apply to every corporate treasurer who's in attendance today. But what we hopefully will be able to provide and what will hopefully be relevant for everyone here today is having a framework for approaching this new crypto asset class. And so we're going to start off our conversation looking at the basics of the corporate treasury function. We'll move into some of the risks and key considerations that corporate treasurers have. We'll explore some of the solutions that the companies represented here are using and providing corporate treasurers. And we'll end on some of our thoughts on, how corporate treasurers can position themselves to best understand and utilize more niche things like DeFi tools. So there's a lot of ground to cover today, but why don't we kick it off with a round of introductions from our panelists. Maybe let's start with Marc Nichols. We can go over to Marc Lamb, and then I'll introduce myself.
Wonderful. Thank you, Leslie. And hello, everyone. As Leslie mentioned, my name is Marc Nichols. I am part of a firm called Arbor Digital. We are asset managers specializing in crypto or digital assets. And one of our core functions is servicing clients such as family offices, high net worth individuals, and other institutions across the country and putting to market an investment strategy around crypto assets.
And it's great to be here. My name is Marc Lamb. I'm the CEO of CoinFLEX. I've been in the crypto space for 9 years. I started the first UK Bitcoin exchange and then went on to start CoinFLEX, which is at the intersection of the futures exchange space. We're a futures exchange. We're also a stablecoin that the only stablecoin that pays interest, Flex USD. And we have a borrow lend platform, which we call a repo market. So looking forward to being here.
Great. And hi, everyone. My name is Leslie Lamb. I'm the Chief Marketing Officer of CoinFLEX. So it's the same platform. Marc and I are related. We're husband and wife. So we share the same last name there. But I've been with the company for about 9 months now, but have seen this company grow for a fairly long time over the past 3 years. I've been in the crypto space similarly since around 2013, but not active really in the space until 2018, and have worked across a number of sales and marketing positions with crypto companies globally. And I also run the Crypto Unstacked Podcast. I've had Marc Nichols on the podcast, or actually, sorry, I've been on his podcast. I'm excited to have Marc Nichols on my podcast very soon. But the podcast Crypto Unstacked does focus on crypto education. And we're so excited to be able to put this together for you guys today on a topic that is sort of under the radar, but becoming increasingly important to a lot of the institutions who are looking to get into the space. And we really do want to put forth a high quality conversation to address some of the questions that these institutions have. So with that said, why don't we get started? Marc Nichols, maybe you would like to take this, but let's just set the tone here and set the picture for our audience. What is the role and responsibility of a corporate treasurer?
The corporate treasurer serves a lot of different functions. I guess you can center around first what their goals are, right? So you're talking about short-term liquidity needs, cash flow management. You can go into the longer term, which is, investing the balance sheet, generating, additional income, or, optimizing the balance sheet. So those are a couple of the main goals of a corporate treasury or a corporate treasury management team. And then the functions that go across that range from, cash forecasting to accounts payable to, working capital management, payout strategies, and another thing is, raising funds for, business initiatives. And I think what we're starting to see, and this was happening even before blockchain, was the relationship between corporate treasury managers was evolving to become more closely aligned with the CFO and CEOs, and they were going to get their input on being able to execute on some of these bigger business strategies. And that was going more onto the treasury management teams. So those are some of the few things that we've seen, especially talking with, teams across the US. We focus mainly on the US. And hearing what their needs are after they come to us and are looking to get educated us on blockchain, distributed ledger technology, and crypto assets. So that's what we kind of see as the core functions and goals of a treasury management team.
What do you get is the sense of interest right now to deploy, part of the balance sheet into crypto? Like, just looking at the US right now, from those that you've spoken to, are people ready to make that jump?
Ready? Probably not, but I think that's where the conversations are being had now. And I think that's where you have teams doing their due diligence, getting educated on what this technology is and what it can enable. I think you read the headlines, you see MicroStrategy and Michael Saylor, incorporating Bitcoin onto their balance sheet. And then, now leveraging and then, going and buying more with that leverage. And then you see others like Tesla or Square adopting, and I think you see this trend of these more fintech firms are more willing to put this on their balance sheet. But I think now you're starting to see these bigger global companies who see the payment systems and the infrastructure that could optimize their operations. They start to get excited about those things now, and not just the yield properties of these, stable coins or Bitcoin, or the possibility of generating more yield, especially as they're going out managing the risk of what having a dollar heavy balance sheet is right now.
I think one of the main questions, just coming off the back of, setting the scene here, is whether the responsibilities of the corporate treasurer are changing, or whether the tools required to carry out these responsibilities are changing, right? I think that's the opportunity that crypto presents. Is you still perhaps have the same focus of cash and liquidity management, but now you just have more tools in the toolbox to be able to achieve that goal, whatever that might be for your company, whether you're a small to medium business or a large, corporation like a MicroStrategy, right?
Corporate treasuries are treasurers are more likely to adopt something that's pegged to a dollar but earning yield, some sort of stablecoin play. Obviously, we've got a product for this. It's FlexUSD, but then just Bitcoin outright. The difficult thing with the Saylor approach, Bitcoin or ETH or any crypto asset, the difficult thing with the Saylor approach is obviously there's volatility, but even more than just volatility, you have the accounting problem where on the way up, the accounting rules in the US and in many public markets don't allow you to remark that value increase. But on the way down, you have to mark every dollar down. So if you buy $1 billion worth of Bitcoin at 40K, it goes down to 39K, you have to remark your balance sheet. It goes up to 50K, you get none of that is credited to you from a balance sheet perspective. It looks like your balance sheet is at cost at 40K. So I think that's one of the difficulties from an accounting standpoint and kind of credit worthiness standpoint that is just a difficulty in owning crypto. And it's kind of a question as will derivatives play a role in helping with that? Will the accounting rules change? Will there be other jurisdictions that solve this problem? There's a lot of open questions around what's going to be the best way that problem gets solved. But I think that is one of the problems with holding crypto on the balance sheet.
So I'm curious to know, from the financial advisor's perspective, right? You are a service provider that has to manage the sort of macro view for clients. And so Marc talked a little bit about the accounting issues. Is that one of the main challenges that comes up, apart from just learning, right, how to get into crypto itself? Is accounting one of the major challenges for these corporates as they're looking to adopt crypto?
Yeah, and I think we'll probably talk about this a little bit later when we talk about adoption. And it certainly is one of the main barriers. I mean, we at our firm, we have the fortunate piece within our team is we have, a CPA on staff who, has a rich history in managing hedge funds and managing risk and all these things. And, he talks a lot about how we have to manage clients looking to incorporate these types of assets onto their balance sheet. And just, it's a tax nightmare right now. The infrastructure really isn't built to manage these types of assets. You're talking 24/7, you're talking about wallet addresses, everything's open in public. So right now, although the future iteration of utilizing, DLT and these crypto assets, there is a better accounting future. Right now, the molding between the two is just it's actually a barrier. It's not easy to see. It's not easy to track right now. Everything is in code. So it's really a difficult piece for anybody to get behind. It's actually and that's where proof of concept solutions like, what's being developed with CoinFLEX, and, Gerald isn't on the panel right now. Hopefully he'll be able to join, but like what Arc is building with their BTF, hopefully these concepts will help with those accounting issues that come in and the tracking. But yes, it's one of the main barriers. And I think that's until we solve that, that will probably be one of the things that will lead to more adoption.
Absolutely. By the way, if there are any accountants in the audience and you want to, add a comment in the chat group for everyone to give your perspective, please feel free. Let's make this an open conversation. So we talked, at the top of the conversation about what the corporate treasury function is, and now, cash and liquidity management obviously will be top of mind regardless of kind of how mature that treasury function is. But one thing that I've come to notice just as I've been reading more about corporate treasuries is that the treasury function deals not only with the current cash on the balance sheet, but also future cash needs, right? And one of the ways I've seen the role of treasury being described here is that it's to ensure the right amount of cash is there at the right time, at the right place, in the right currency. And this is taken from a report by PwC on the corporate treasury function. Marc, how can crypto come into play to satisfy a corporation's future cash needs? You alluded, to this a little bit, with kind of considering the role of derivatives in the way that you can hedge, for example, cash flow. Marc Lam, what are your thoughts on the role that crypto can play here?
This is kind of where FlexUSD is a powerful product, because obviously it's a stable coin, so it's always redeemable for $1 with no fees, but it's earning interest. And when we look at the field of other products in crypto, especially centralized ones, where they have interest products, there's often withdrawal limits, or you have term deposits, fixed 1 week, 1 month, et cetera, terms. And that just, as a matter of fact, it makes it difficult to plan your cash needs, because if you don't have that immediate redeemability, you have to pull back on what you're going to deploy and kind of brace for that worst case scenario where you might need to acquire a company, or you might need to, things on the marketing side might need to go really well. You might need to scale that up, or some emergency may have happened. You may have to, basically pay out cash to deal with some issue. And so this is why we've designed FlexUSD to be immediately redeemable for free every 8 hours, and immediately for kind of the last 2 interest payments, while it's earning interest every 8 hours. It's kind of the best of both worlds. There's no lockup, and you're earning sort of best in class interest from the highest possible rates in crypto in the collateralized world, which is the futures markets. So you're kind of getting that best of both worlds. You're getting high interest from people who are trading futures, and then you're also getting direct redeemability. And that's what people our customers, they call it hyper liquidity. It's a hyper liquid stable coin. There's no discount when you redeem it like some others have, and it's just straight up goes straight into cash. So yeah, I think that's we're trying to build this in a way where a corporate treasury could very easily adopt it, because they don't have to plan anything. If you're holding short-term cash in Flex USD, you might be holding it for a year, you might be holding it for a week, you might not know. And because you don't know, because you don't know how much cash you might need in a week, in a month, etc., it's instantly redeemable. So that's a really helpful function for those folks.
I'm glad you went into that, Marc, because it's really important. I think what we've seen on the headlines too is, I think as a longer term hedge against, all the inflation risk, exchange, interest rate risk that, corporate treasury managers are trying to go and accomplish. You see Sailor and everyone buying Bitcoin, and, maybe that will serve as the longer term hedge. But with these short term needs that you're mentioning, there needs to be a better solution than what's been currently out there, specifically within crypto. And so that's where I see, and why we preach and why we say that there are things out there that are looking to solve for these shorter term needs, right? Like not every corporation is looking to maximize and optimize for the long term. Yes, that's important, but there are all these, like we mentioned at the beginning, there are these shorter term and intermediate term needs to where something like a Flex USD can come, and you're not, losing, we all know what the interest rates are, what it came in on your short term and intermediate, and especially for treasury managers, as they're looking to, weave into more of the fabric of the success of the overall business. That's really important to be able to execute on those things that you went through.
Why don't we dive into now a lot of the conversations that you have, Marc Nichols, with clients as you help them assess the risk trade-off, right, of getting into crypto and having that on their balance sheet. What are the risk trade-offs that a treasurer has to keep top of mind?
Yeah, and that's kind of the first thing we always think about, right? We don't, especially as we work with these family offices, high net worth individuals, and then just because we work with them and now we have institutions who, are saying, oh, wait, can you help us on this side of our treasury management? And so the first thing we tell them is, you don't want to just move one risk and go to a different risk area. So, when you go into crypto, there's obviously your risk, and especially if you're looking to go more actively into decentralized finance, you start getting more smart contract risk or, software risk, exploited code or whatever the case is. Yes, you're getting out of the risk of, inflation numbers are the way they are. Your cash is losing value, and, what is it? The assets that you want to go do M&A and you want to go do all these business, all that's getting more expensive. So how do you manage that risk? You don't want to just transfer that to a different risk. So the risk we always make sure we tell them you have to be cognizant of are those, technology, more software, more early adopter risks that come with going into crypto. And that's where, again, we need better solutions that will address these types of risks, because the last thing you want is if you go into DeFi or if you go into these other, centralized players who are offering kind of these yield-bearing products. Last thing you want to be is on those headlines that says, $100 million exploited from a smart contract. And now it becomes a mad dash to just react and be able to solve for that and get the money back in. That's not a risk that you should be taking on. So yes, the yields are attractive, but that's where I think something more disciplined, more responsible is needed. And that's where, again, I see something like Flex USD, or I think there's a few others. But I'd be interested to hear from you guys, Marc and Leslie, kind of what you also see as the risk there, because that's the first thing we tell clients, because they come in wanting the yield properties and they say, okay, 12 to 15%, I'm in. And we say, okay, here's the risk you're taking on to get it. And that's where I think something more measured, and that's where they're more willing to take something smaller too. We don't need 15%, 6 to 8%, more than enough.
Yeah. I mean, this is where I think there's sort of a difference in approach on the centralized versus decentralized structure. And I think there is something very important and valuable in being able to, in a human way, human plus automation way, slow down and make sure that something that looks risky doesn't make its way to actually withdrawing funds from the system. And I've been running exchanges for 9 years. We've been barraged with hackers every single day of those 9 years, and it's just a lot easier to deal with hackers when all the funds are in cold storage. Because just in case they do make it through some system or barrage the API with requests and spam their way through certain things, you have this final ability to do a manual step before letting a withdrawal go out. And this is what we've seen. I mean, we saw recently a protocol got hacked, something related to beans. The hacker did a flash loan, borrowed $150 million or something, bought up all the governance tokens. Basically, by buying up all the governance tokens, had the right to vote on changing the protocol, and then changed the rules of the protocol so they didn't have to repay the loan. I mean, it's genius. It's very unfortunate for the protocol. And this is what happens when you have a system where, and this is not specific to DeFi, but it's what happens when you have a system where the rules can be changed instantly. And so that's a tricky thing. That's a tricky edge case to cover. It's one they should have thought about. It's one they should have covered for sure. But it's definitely a lot easier and a lot simpler just to have that extra manual step of funds in cold storage and everything having some level of manual overview while there's automated systems and automated risk management going on. And so I completely agree with what you said, Marc, about smart contract risk. This is why at the end of the day, Flex USD is a centralized stablecoin that can be used in DeFi. We're strong believers of DeFi. We're very bullish on DeFi, and we want to be paying interest on all of the dollars underlying in DeFi. We want Flex USD to be the currency of DeFi, because if it is, everyone in DeFi is going to be making more money. There's going to be making whatever farming yields and whatever LP yields and whatever trading, profits they're making from that. But while they're doing that, they're also going to be making their Flex USD interest rates. And so, yeah, I think it's really important. These different things are going to be really important. But from a corporate treasury side, I do think they're much more likely to touch products that are centralized, just for the simple fact that smart contract risk is difficult to price in, it's difficult to insure against, and it's a lot easier to sleep at night if you don't have it. So that's how we built our products, and we want them to be used actively in DeFi, and I think it's sort of unlikely that that's going to happen with corporate treasuries, but very likely it'll happen with a whole bunch of other players.
What is the interest, Marc, Nichols, from the clients that you've been working with to understand similarly the opportunities in DeFi?
I think last year was the year for people becoming aware, but now people are taking action. Teams are taking action. And I think especially when we talk about corporate treasury management, I think there's been a shift. And I was reading a study that, Ernst & Young did about, this, corporate treasury has been moving from this, we need corporate treasuries to be less reactive, this need to be tactical and kind of in this mode of keep us out of trouble, to more being able to be strategic and help the business perform. So they're now taking action to how we can do this now that they see, and I think that this is where when you hear narratives of, inflation being transitory for a year, right? And that was last year, inflation was transitory. And then now you start to see, okay, it's not, maybe it's not. And, and not just maybe, it's not. There are many other things underpinning, and why that is. But now they need to take some action. Now they need to do something, and it's forcing these corporate treasurers to go further on the risk or to try to adhere for this. But that's where you're seeing more action in terms of, okay, let's set up the phone calls. Let's learn about how we can take advantage of them. Where's the opportunity? Because we're setting up, generational firms. This firm is going to last the next 50 to 100 years. We're not just thinking, and that's kind of the similar thing what we see with these high net worth individuals who are planning out multi-generational wealth strategies. and they see these longer term holdings, and they have goals they want to meet. They want to fund certain things over 2 or 3 generations, not just their own lifespan. And so we see a certain thing that's happening within these corporate treasurers is they need to plan further out on those longer term assets, not the shorter or intermediate term, but that's what they need, and that's not going away. And so now they have to start really building these plans out and how they're going to strategize around this and create actionable steps too, so that way they can still conduct business, grow, and thrive in this, again, unprecedented, and I feel like that's an overused word, but it truly is environment that we're not just in today, but obviously for the future.
Yeah, one thing I found really interesting, Marc, Nichols, that you mentioned to me before is that you're already starting to work with clients who are DAOs, and you're helping them to figure out what their DAO treasury looks like. I think that's super fascinating because that's not what a traditional financial advisor is hired to do. Let's just put it that way. And so you are in a very unique space where you're straddling the multi-generational families, the high net worths, to help them understand the traditional market, right? Navigate that and kind of get into crypto, but you're also working with pretty crypto native structures as well, such as DAOs. And we're at a point now where there are enough DAOs out there, many that are mature enough to begin to think strategically about how they want to be, investing their treasury. So can you talk to us about what that experience has been like and what's top of mind for, these sort of DAO managers, if you will?
Yeah, well, that's where, we've had the fortunate, advantage of being early adopters. We've been allocating to digital assets and educating ourselves for the last, 5-6 years, and actively have solutions for investors for the last 2. So now we have these crypto natives who have built wealth, and they're establishing these new business structures through DAOs. And one of those DAOs that we are heavily involved with is called Planner DAO. And they're trying to build solutions for other DAOs to manage it, because a lot of these they're business owners, they're CEOs. It's just a different type of structure now that they're building their business around, which are these decentralized autonomous organizations. And a lot of them don't have the finance background to understand what it means to manage a treasury. And especially with everything that's new in terms of, they have this treasury, so think about your traditional corporate treasury. You've earned those dollars to put into you've either raised funds or you've earned it through income streams, whatever the case is, you've earned those dollars. And what's very different about DAOs is you kind of create them through an IDO, ICO, or however, and now you've created a treasury. And then now you have, hopefully you have a monetary policy with your DAO. So how do you manage your treasury in coordinates with your monetary policy and your inflationary, deflationary, whatever monetary dynamics you put within it? How do you manage all those things? And that's where the questions come to us now, because we're early adopters. How should we be thinking about this, Marc? And that's where we have to kind of put our consulting hat on and say, well, these are what you would think about traditionally. But since you're doing it this way, this is where you need to kind of go outside the box. And so we're helping them formulate what they should be thinking about, the risks inherent that they should be thinking about, not just today or 6 months from now or a year from now, but 5 years from now, 10 years from now. So that way they can continue to extract value and build and accrue and do the things that they want to do as a DAO, right? And that's where, again, everything is still so short-term thinking, and just the benefit of having someone like us come in and help them think longer term. They then start strategically building what needs to happen for more long-term success.
Earlier in our discussion, we talked a little bit about, or we hinted at, whether it would be, best suited for corporate treasurers to invest in Bitcoin or Ethereum or stablecoins, right? There are so many different assets that a corporate treasurer, I think, has to look at now, regardless if they actually invest in it. It's just to understand, what does it mean to have this asset on the balance sheet as it relates to both the short and long-term goals and needs, of the company. Marc Lam, do you think corporate treasuries are more likely going forward to, continue choosing Bitcoin or Ethereum Or do you think they might be choosing so-called dollar-denominated crypto products, such as a stablecoin like FlexUSD?
Yeah, I mean, obviously biased here as running a stable coin, but I think there's at least $200 billion a year opportunities for corporate treasuries and stable coins. And one of them is in payments, and one of them is from earning interest. So if you think about the world as it is today, there's about $5 trillion moving around the world via Swift every day. And that capital is extremely inefficient in multiple ways. But just from a time perspective, especially with a lot of the more non-standard countries, if you're moving money from India to Brazil or something like that, Nigeria to Kenya, these types of movements, it takes many days to do these movements. Maybe one, maybe three, somewhere in the middle, could be a whole week. And so these payments are slow and sluggish. And really all of these companies that are moving this money around the world, that cost is enormous, because with that time, they could be earning more money. They could be making more, let's say you're an import-export company, you receive goods, you make a payment, you want to recycle. The more you can recycle those funds, the more money you'll make at the end of the day. And I think simply making payment systems more efficient probably gets you $100 billion mainly from the added productivity you get from stripping away that 1 to 3 days and getting it down to 30 seconds, but also from removing credit card fees and debit card fees and Swift fees and these types of transaction fees. But again, I think it's probably less to do with the fees and more to do with the time-based cost of losing access to that capital from a balance sheet perspective for several days. How much funds are in transit? Well, that's your cost right there. And then the second one is how many trillions of dollars are in corporate treasuries. It's quite a bit. And when you think about how much that's losing, Apple has hundreds of billions of dollars in cash. How much is that losing every year to inflation? When instead it could be earning interest. And yeah, sure, it's earning treasury yield, but crypto yield is the best form of secured yield in the financial universe. When you think about, there's bond markets where you're taking unsecured risk. You might be senior on the credit stack, the senior to equity, all sorts of things. But at the end of the day, you're taking unsecured corporate credit risk, commercial paper, all these things are different forms of financing that are not secured financing. What we have with repo, it's a secured lending market secured by collateral cryptocurrency that can trade and be liquidated and be sold on the market and be brought back into cash 24/7, 365. There is no closing of this market. It can be sold at any point in time. And so the risk of crypto, I think, and the liquidity of crypto is better than any other financial market. And so why not have those trillions of dollars be held in a stable coin like FlexUSD or some other type of interest earning opportunity that earns from the crypto markets and the yield that is being spun off by crypto markets? These markets are enormous. These markets have so much demand for leverage that's not being fulfilled because banks and the Federal Reserve are not, lending into the crypto markets. And so really it's an opportunity for everyone else, the large corporates, the retail, the high net worth individuals, everyday average Americans, to come in and plug that gap and take advantage of this opportunity. And I think both, the payments and the interest are $100 billion plus per year opportunities when you think about all the cash sloshing around, one, being delayed by Swift, and two, not earning any interest. So
I would love to add to that. Swift launched a proof of concept, blockchain or distributed ledger technology gateway in 2016, and they've been working on it. So I think what it's important, if you're on the call now and you're listening to this on demand, you want to kind of separate what you see in the headlines as the only or the primary narrative driving, especially for corporate treasury managers, what's driving those headlines around utilizing stablecoins or Bitcoin or other crypto, within corporate treasury management, and kind of go into, we have a funny line that we go, come for the yield, stay for the system optimization, right? Because you're going to see, you're going to be able to transact. I mean, the line we like to tell people around this is, the unlocked value of the assets as well as the networks is conducting business around the world 24/7 at the speed of the internet, by the way, with a lower cost, both from a time perspective, which you highlight really well, Marc, which a lot of people forget to think about, but also from from a fee management standpoint, it's much lower cost. And I think that's what's going to get especially treasury managers excited in the morning. And, especially this transition from, digital, I think corporate treasuries have been moving more to this digital mindset already prior to, 2020 with, blockchain and crypto assets. So I think this is only going to accelerate that. And I think if you're listening to this, that's where you probably should start focusing on. And that's what we help people do. And, as you guys have mentioned, some of these high net worth, and a lot of these high net worth individuals are CEOs. They're running companies at the same time. So that's why this conversation just ends up morphing into and being valuable on both ends. But I mean, Marc, you said it very, very well, especially from the time perspective. It's just that there's so much opportunity here.
Once someone understands how to use an Ethereum address on any EVM blockchain, but once they understand how to use crypto from an address management perspective, wallets, these sorts of things, they can never unlearn that. Once you're familiar with this infrastructure, you can never unlearn that. And anytime you have to go back then to the banking system and put in that wire instruction and wait for unknown amounts of time before your funds might get bounced back to you because some clearing bank didn't do what their job was to do, it's just difficult to go back to that. And the first time is scary. It's you have this address and it's new and it's, oh my gosh, what do I do with this? How do I, but you quickly learn, like double check the last 5, double check the first 5, do a voice confirmation if you need to, and then send it out. And there's now a bunch of different tools and systems that make this easier, lots of custodial infrastructure that makes this easier. But once that blockchain education is done in the eyes of anyone using payments at any corporate or multinational, group, it's especially from an institutional perspective. If you as a business are able to make that payment and your supplier is able to take it, and from start to finish, it's able to be made, it's a network effect as well, because all of a sudden you start asking yourself, well, wait, hold on, we have a bunch of employees that are not in countries we have bank accounts in. Maybe we can ask them if they want to take payments in FlexUSD or some other stablecoin or something like that. Maybe that could be an option. And you start asking more of these questions simply out of self-interest. You want to save on costs, and maybe it's a feature you can even offer to some of these people around the world. And so that, I think, is one of the powerful things about crypto is, as a payment network effect, it's very sticky. Once, there's an anti-network effect. Fiat banks and traditional payments have a network effect too. So we're fighting against that as a crypto economy. But once someone has made that jump, bridged over into the crypto blockchain, they're never going back. They're always going to be familiar with it, and they're always going to be looking and seeking out ways where they can use crypto for the payments they do in their lives, whether it's on an individual basis or a corporate basis.
Yeah, and I think one of the risks we haven't even talked about really, and which is, again, especially for managers, is really important, is the regulatory environment, right? And I think that it's kind of a buzz narrative, regulatory environment. We need clarity, we need all this. But I think narrowing it down, when you talk about regulatory risk in this space, it's very real. And so that's where what you want to pay attention to, and this is why there's been a push from certain entities for CBDCs. They know that this is the upgrade to the system that is coming, but now they don't want to lose control of it, and that's what they kind of see right now. But that's almost inevitable at this point. That's where as crypto becomes more Lindy, more defensible, anti-fragile, all of those things, you're going to see a lot CBDCs work in harmony with solutions like Flex USD, and I think there's going to be a meeting in the middle somewhere. It's where I think right now everyone's very, and most of the institutions we talk to, one of their primary drivers of not doing anything too is just the regulatory side. If they decide to do something, you can't put it at risk in terms of, okay, what if and that's where you start to see, these lawsuits or the SEC or people coming after, BlockFi or these other institutions that are offering these type of crypto yield products. What happens if that comes to us? And there's still that fear, and there's still a lot of uncertainty around the regulatory environment. But I think especially with Biden, and that's where it almost went under the radar with Biden, coming out with the executive order. That was a pivotal moment for sure. And so I think
Yes.
this area that we're talking about was huge in regards to that executive order. I don't know if you guys agree, but that was a massive, and that's where we've had more phone calls with institutional managers since then than we even had over the last year and a half. And I think that was a green check mark, just to, okay, I can go do the diligence now. I can start developing those action plans.
Well, you just want to know, even more than clarity on how the specific regulations are going to fall out, you just want to know that the administration is pro the industry.
Mm-hmm.
And I think it's important for everyone who's looking at this from the perspective of sort of regulation and anyone who's worried about regulation changing in the future, especially in countries like America, but generally speaking around the world, any type of regulatory action has not resulted in loss of funds. The US government definitely, and almost every government in the world, is not interested in causing a loss of funds to users. They may be interested in shutting down bad actors, and sometimes they even catch some good actors. They don't always do the right thing. The regulators do their best, but they sometimes make mistakes. But the key thing is, at least in crypto's history in America, there's never been a situation where they've caused a loss of funds, and that's where we're very bullish on crypto in the US, because we think not only is there a level of care and a level of kind of respect for the industry, but also they're moving in the right direction, specifically with respect to stablecoins. We've seen statements by the Fed around how stablecoins should be regulated. We're very much aligned with their understanding of stablecoins. We think they have a good grasp of the industry, and we think they also have a good grasp of the importance of the industry. Not only do they understand the concept, but I think the Fed specifically and the U.S. government generally have a very useful understanding that stablecoins are important for dollar dominance and dollar proliferation abroad and internationally. It is something that ultimately gets more people around the world using the dollar. It kind of goes where Swift may not be able to go, or may not have an easy time going, and furthers the usage of the very powerful U.S. dollar, and that's a good thing. In many cases, there are many countries where they don't have very sophisticated local currencies, and the central banks maybe don't have a great track record managing currencies, and now people have access to dollars. People that would not be able to get offshore accounts and international bank accounts and these types of things, and would not be able to hold their funds in dollars. Maybe buying physical cash would have been almost impossible. But now getting stable coins makes another form of escape from these hyperinflationary currencies available to them. And so that's also a good thing. And I think, the US government is very cognizant of these things, and cognizant of how stable coins are affecting dollar dominance generally. And that's what we're bullish about. That's why we're launching in the US. That's why we're kind of very bullish on America.
Yeah, there's something to be said whether allocating a portion of your balance sheet to crypto as a non-U.S. corporate treasurer is a form of a regulatory hedge, right? And we talk from the perspective of individuals and also corporations that do deal with dollars, which for all intents and purposes works because it's part of the most sophisticated financial market in the world, which is the U.S. financial market. But ultimately, there are corporations all around the world, and many of them who are in jurisdictions where the local currency is subject to heavy government manipulation. I think I can say that word. It's a pretty heavy word. But what that results in is things like hyperinflation. And this is one of the main reasons why, crypto as a use case is top of mind for these people. Because it is their primary alternative. They don't see Bitcoin, for example, as necessarily just a store of value that they'll just speculate on and like hope price goes up. It is to lock in as much purchasing power as possible, from the income that they're generating during the present. And I think when we start to, have more of these conversations around the use case of crypto, right? Because at the end of the day, if we can't use crypto, then what are we all here for? And that's one of the biggest pain points right now is that when you do look to a Bitcoin or an Ethereum, there's very little that can be said when you want to talk about the movement of these so-called currencies across borders, right? That's why, CBDCs, they are top of mind because it points to the use case for corporations and institutions for cross-border settlement, which is fairly useful. Stablecoins being used as a mechanism to, settle payments, very, very useful. And it's actually one of the main reasons why USDT, for example, has taken off so quickly in Asia. It's for the pragmatic reason that corporations are using it to, settle invoices and payments, whether it be so-called underground, right, or above ground, whereas sort of the regulatory, a clarity around using, stablecoins is not very clear. Either way, stablecoins has been a clear alternative to cash. So I think it's a very, very interesting, topic that we're on right now, which is just, seeing the role of stablecoins, as part of the adoption by corporate treasurers. But I did want to get to a question that is in the chat currently by Adam Blumberg, and either one of you feel free to pick this up, which is, what about treasury managers that count on the inefficient systems? They like the paper processes and float.
Yeah, no, I mean, I think the biggest example of this is probably the banking system. When Swift is waiting those 1 to 3 days, they're not waiting because they have no idea the internet was invented. They could be settling this much, much faster. And that's absolutely correct. What float is referring to is effectively money that is other people's money that you as an institution are holding on to for some period of time, and you don't have to pay interest on. And you don't have to pay out interest, but you get to collect the interest. So when the participants in the Swift network hold on to the money for 1 or 3 days, they are earning daily interest that they don't have to pay anything out on, and that's why they actually have an incentive not to innovate. It is a paper process. It is also, not only do they have an incentive, but they haven't made any steps to make it much more efficient than it is today, than it was 20 years ago. So yeah, I completely agree with the comment, and I think it's one of the reasons why crypto and stablecoins and blockchains are going to win, because we have the opposite incentive. We have the incentive to be as efficient as possible, as user-friendly as possible, and pay out, in the case of FlexUSD, pay out as much interest as possible.
Well, I might have one more question to kick over to you, Marc Nichols. So this is another one from Scott Bloom. Outside of government regulations, how much weight / momentum does something like Blackrock or Fidelity backing a stablecoin such as USDC hold, in your opinion?
It's a great question. And I think it comes down to this comfort level and trust factor. When you get the largest institutions in the world that have participated in building and maintaining the traditional systems and financial markets, there's a level of trust that comes with that when they start announcing partnerships or initiatives to start adopting building infrastructure. So again, it's another reason to be bullish on the long term. Again, short term, you may not see that reflected, which is, I think, a misconception when you start to see these headlines, and those are reasons for price movement and all those things. But those are absolutely great things for the industry. That's coming from someone who comes from the traditional world. Now, if you talk to a crypto native, you might get a different answer, right? So someone who's really championing the decentralization ethos and looking to build the new Blackrocks or these new institutions, they're probably going to have a different view. But for me, my view is that we're going to meet somewhere in the middle, just like with everything that's happened historically with any type of new technology that's being built, such as the internet or the printing press, whatever the case is. There's always that for all the way on the outside spectrum. We always usually meet somewhere in the middle, and that's where I think bigger players right now. We've seen so much happening within the crypto native scene and building the infrastructure. So now that we're starting to get the other side coming in, it's only going to accelerate us meeting in that middle somewhere. So very bullish when we see those things happening.
Excellent. So I don't see any other questions rolling through right now, but I did want to, lead the last few minutes here just to open it up to the both of you, right? To either talk more about your respective companies, your the kind of company's vision for how you're working with maybe not only with corporate treasurers but other types of crypto participants in the space, or how you're onboarding the non-crypto guys into the space, what your process and method is. I know Marc has tons of stories to share from just our kind of client conversations, but Marc, Nichols, yeah, maybe I'll kick it off to you just to give you the floor here.
Sure. And I won't go too, we've talked about a lot, and I know it's a lot to digest for everyone that's on the call or listening to this on demand. But I'll just leave you with this. You're going to see so much happening on the headlines. And that's where the most important thing I could say, especially if you're in corporate treasury or you're part of a team who's looking to adopt, don't just think about adopting the assets. Think about the adoption in terms of the network. And Marc used the term network effects. Look for those things that are happening. And it kind of dovetails into that question that came in around when you see Blackrock and all these other players. Network effects are being established every day, and you see the adoption, you see more wallets, you see more transactions, you see more activity, and that's what we really pay attention to. And so that's where we get excited about things, and us as market participants as well. We're looking for solutions, Arbor Digital, for while we manage portfolios and we're asset managers, we are also participants. So when we see something like Flex USD for us, and we see as a potential solution, and even though they weren't able to join today, ARCA and their BTF fund and kind of their proof of concept there, and you see this molding of new innovative things that are coming to market, we're going to use them all, and we want to test it. We want to see what's going to be the most efficient vehicle for us to use. So we get excited to use these things, and so that's where I know Flex USD is launching in the US, and the BTF. If for those of you who haven't seen or read, there's a white paper that ARCA released, a month or two ago. Definitely go read that. It's innovative. It's and it's an important piece, and it's all towards establishing these network effects. So that's what I'll say, and I'll leave the rest to you guys and talk a little bit more about Flex USD and kind of what's coming there for sure.
Flex USD is coming to America. Everything else, I think you summed it up really well. So yeah, I'll leave it with that.
Okay, so we have two questions. Maybe I'll start with Raphael Kostenbaum. Prior to Flex USD being $300 million, say a year ago, what market cap were you thinking it was going to reach?
Oh, I mean, I think we didn't expect it to grow to several $100 million this fast. But at the end of the day, we're really excited about where it's at. We're really excited about how fast it's grown. And we're basically looking to get, get FlexUSD into the tens of billions. I mean, the capacity for this trade, the repo trade, this investment strategy, this kind of deployment of cash strategy is, unbounded. In equities, it's this kind of the same type of secured lending and derivatives on equities is about half the market cap of equities. So, crypto is almost $2 trillion. There's no reason why the leverage in crypto in this type of secured financing way couldn't be $1 trillion. So we're really optimistic on the interest portion of FlexUSD, and then it's just a question of how many people want to capture that interest. How many people want to get interest paid on hopefully what will become $1 trillion. And I think that market is absolutely enormous. It's everyone with cash in the bank, every corporate, every individual that uses money in the world. Beyond America, most all of our users right now are outside of America. So it's really everyone everywhere. And I think the biggest stable coins today are worth the market caps are about 50 billion and 50 billion and 80 billion respectively. There's no reason why we couldn't get to several hundred billion from FlexUSD, given that it has all the advantages of these other stable coins, and it also has the interest advantage to it as well.
The stat that I like to quote is that the market cap of all stablecoins is larger than the market cap of Netflix, which is very relatable for most people who are not aware of just how vast this market is. I want to leave it with one last question here. I think it's really important because those in the audience are probably very familiar with USDC as one of those dominant stablecoins, Marc, that you mentioned. So it's another question from Scott Bloom. Given that FlexUSD is collateralized with USDC, how comfortable should a corporate treasurer be with holding FlexUSD versus a Circle yield product, which for those who are not aware, are solely for institutions? This is not available to the retail USDC holder.
Yeah, so I think there's a few fundamental differences there. Obviously, yes, the backing and the redemption of FlexUSD is USDC, so there's a lot of similarity. But the biggest advantage in our product versus theirs is that there's no redemption lockup. With Circle's yield product, you have a kind of 1 month, 2 month, 3 month, etc. kind of redemption cycle, and so you're really locked into holding funds with them for some period of time, and you have to kind of plan your cash needs accordingly. And again, as mentioned, for a corporate treasurer, this is going to be one of those things. It's going to factor into the calculus. It's going to hold back how much cash they put in, or in some cases, if depending on the company, it's going to mean they can't use the product at all. With a FlexUSD, you get what we call hyper liquidity. You can redeem for free 3 times a day. You can redeem at any time instantly for a minuscule 1 or 2 basis points fee. So it's really that hyper liquidity is probably the biggest difference. And the second difference is just in how the lending is done. With Circle, it's bilateral. You don't know who they're lending to. They mention one borrower, but they don't really talk about others. And with CoinFLEX, it's all in our repo market. There's literally 100% transparency on every trade that the repo market does. You can crack out your API skills and actually look and see all of the repo lending activities in the FlexUSD product, and it's all completely open to the public. And so that feature, and we're about to get this audited and attested to by an auditing firm. That feature is really superior from a transparency perspective as well. So I think the main differences between ours and a lot of other products, it's a stable coin, so you can use it for actual payments while you're earning interest. It's hyper liquid, it's redeemable at any time, and then also it's just it's totally transparent what's going on in the back end.
Excellent. I think that was a great breakdown. Well, folks, thanks so much for spending today with us. I know for some of you it is a holiday. But we just thought this was, a really good opportunity to make some headway into this really important conversation about how crypto is looking to disrupt the corporate treasury, management, tool set, and just really excited to be, doing more of these with you guys. Marc Nichols, thanks so much, from Arbor Digital, Marc Lamb from CoinFLEX. And, hopefully next time we can get more of our panelists on board here to share, differing perspectives on this important topic. So thanks again so much, everyone. And yeah, look forward to having this out on replay very soon.
Thank you. Thank you, everybody. See you soon.
Thanks, everyone. See you soon.